All right, let's take a look at another exercise that focuses on return on equity, financial leverage, and DuPont analysis. So we're going to be introducing a couple of things here. We've looked at return on assets in another video, and then we're going to be looking at kind of an oddball ratio called return on financial leverage as well. Okay, so we have some selected data from a company. Let's see here, their name is H.D. Winkler, and we have some selected data from their balance sheets and from their income statements, and these are what we would call comparative statements as they go for a number of years. So on pretty much all of these requirements, there are three of them, A, B, and C, they want us to calculate something for each of these years, and we simply do not have that kind of time. So what we're going to do is we're going to do just 1 year for each of these. So for example, on requirement A, it says calculate H.D. Winkler's ROE for fiscal years 2019, 2018, and 2017. So we're going to focus our attention on 2019, and again, that we could have picked 2018 or 2017. We just do that again in the interest of time. I will say this: what you'll find out is that when we're doing this, we need 2 different years, and so we cannot do 2016 because we would have needed 2015 over here, and we don't have that. So we're going to focus our attention on ROE for 2019. This company have their statements stated in euros. That is absolutely irrelevant to our purposes. Okay, so calculate ROE for the year 2019. Well, the formula for ROE is simply earnings divided by average equity. All right. And so if we look at our earnings for 2019, we have 850. And then we have to take our total shareholders' equity of 138 for 2019, and we're going to add to that 1477 from 28, and then we're going to divide by 2. So let's bring our calculator over here and do that. 138, that's our equity for 2019. Well, let's see, I made a mistake. 138 plus equity for 2018 is 1477. Okay, and then we're going to divide by 2. Gives us 807.5. So if we take earnings of 850 million divided by average equity between the 2 years of 807.5, we come up with a really big number. We have ROE of 105.26%. And this is an abnormally high level of equity. What I would tell you is that a couple things. There's a couple of reasons why this is so high. Number one is we have a pretty good profit margin here. This is a pretty healthy margin. When we get 10,364 and we end up with net earnings of 850, that's not bad, especially for a large company. But the real reason why this return on equity is so high is because the 2019 equity is really, really low. So this can happen sometimes if a company pays out a lot of their earnings in dividends. And so notice the drop in equity from 1477 to 138. This is not normal. Equity generally goes up rather than down. However, with this particular company, if we were to go, let me move this calculator out of the way. If we were to go from 2016 to 2017, you know, we see, okay, well, we had let's see, equity 1875. We only made 448, and we retained a pretty good portion of that, about half. But then the next year we're making 805, and we're paying out 805, and then some. Equity is going down, or the other possibility is that debt is going up. Now, when we look across this, with the exception of 18 to 19, we don't see any real big fluctuations in debt. We did see some in 2019, but anyway, I just want to point out that the 105.26% for ROE is a bit high, and by a bit I mean really high. And so that's why it is kind of good to look at these over a period of time, so that we can eliminate outliers like this. But if we apply the same formula for 2018, we would look at 805, and then we would use equity 1477 and 2184, and I can tell you right now it's going to go down fairly significantly. Okay, but in the interest of time, we're gonna call it good with 2019. All right. B says calculate their return on assets and return on financial leverage, which has a fairly humorous abbreviation, for each year. Use an incremental tax rate of 25%. The reason that they're telling us that is because we do have some interest expense in all the years. Of course, we're only interested in 2019. So how do we do that? Well, what we're going to do is we're going to take our earnings from operations, not our net earnings necessarily. We're going to adjust that for the tax savings, and then we're going to divide that figure by our average assets, which makes sense since we are in fact looking at ROA. So we already have another video out on how to do this, but let's just look again. We're gonna put that this is for 2019 right here. And so our starting point actually is going to be the 850 in net earnings. All right. However, what we're going to want to do here is we're going to want to add to that. Let's see here now. We had 246 in interest expense. And I'm going to multiply that by 0.75. I don't like getting a lot of brackets and double parentheses and so forth. So what I'm doing here is I'm saying, okay, 1 minus the income tax rate of 0.25 is 0.75. Okay, and so whatever this is, I'm going to divide by average assets. Well, my assets for 2019 are 6108. And then for 2018, there's 60, what does that say? 6451. And then I'm going to divide by 2. Okay, so let's see what we come up with here. We'll take the numerator first, 246 times 0.75. It's going to give us 184.5, and then we're going to add to that the net earnings figure here. Okay, so that's going to give us 1034.50. And then we're going to add both of our assets, assets of 6108 for 2019 plus 6451 for 2018. That is 1259, and we're going to divide that by 2 to get the average. All right. So now I'm going to take 1034.5 and I'm going to divide it by 6279.5, and that's going to give me, you can barely see it, 16.47%. And this is our return on assets. Now they also want us to calculate here in B, where did it go? Return on financial leverage. So we need to be a little bit careful here, because this is not exactly the same thing as calculating financial leverage. The formula for ROFL is very, very similar, and I'm going to show it to you only because it's part of this question, and if you have this question in a homework assignment, you're going to need to do that. Otherwise, I wouldn't bother with it. So all we have to do, so let's just see here. Let's see if we got some room here. ROFL equals ROE minus ROA. So we could say 105.26 ROE minus 16.47 ROA. Calculator back over here. 105, whoops, 5.26 minus 16.47 equals 88.79. 88.79%. And so this is not the same thing as financial leverage necessarily, but what it does show us is that our debt to equity ratio is pretty high, and we can kind of see that if we go back up here. Really, for all of these periods, we see this taking place, but particularly for 2019, where debt is quite a little bit higher, noticeably higher. It's gone up by about 20% roughly, and then our total equity has gone way, way down. So we don't have any problem here with our earnings, but we would say that leverage is high. And so again, this is something that we should have been keeping an eye on all along. I just want to mention this is not exactly the same figure as financial leverage, but it is 88.79%. Okay. And then the third part of the problem, we'll have to move the page around a little bit, wants us to calculate the DuPont formulation. And so if we look here, we see we have the ROE, and so if we take, for example, our net income over sales to get profit margin, we've looked at that previously. Our asset turnover, sales over average total assets, and then we multiply that by average total assets over average stockholders' equity. We call this financial leverage. This is This is going to be a slightly different figure. Then we will come up with our measure, our DuPont measure for return on equity. Okay, so let's go ahead and do that, as this video is already starting to run quite long. So our profit margin we see right here, we can gather by taking net earnings of $850 and dividing those by our sales revenue. Okay, so let's come back down here and do that. Okay, $850. Then they've said net income here, and above it was net earnings. So we're going to treat those as synonyms. And let's see here. Revenues were $10,364. So let's take $850 and divide by $10,364. And we come up with, there's the decimal, so 8.2%. All right. And then we're going to look at our asset turnover. And so we already have our sales of $10,364. And let's see here now. Do we have average assets? We do. But I want to show you where we got them again. The average assets are right here, 6108 and 6451, because again, we're only looking at the year 2019. So right down here, we took those two figures, divided by 2, and we came up with average assets of $6279.50. And this will give us, there is a dot right there. This will give us our asset turnover ratio. So 10,364 divided by 6279.5. All right, and so that gives us a ratio rounded. Let's see here. I'll expand this out. 1.65. Okay, 1.65. So we're going to multiply that by 1.65. Then for financial leverage, well, we've already figured out. We've got this 6279.5, so let's just put that here. Okay, and then we need average stockholders' equity. Well, if we go back up the page, when we were calculating regular ROE, we came. So that was 807.5. So let's see what we have for our leverage figure. 6279.5 divided by 807.5 gives us 7.776. All right. So I'm going to be careful here now. What we're going to need, we've got our equation here. Now I've got that as listed as 8.2%. But move this calculator out of the way so we can see. They say calculate net profit margin, asset turnover, and financial leverage. Well, this is what we need to do with those. We've already calculated those, but now to get the DuPont ROE, we actually have to multiply these out. Okay, so I'm going to start off with my profit margin. So that's 0.082, okay, times 1.65 times 7.776. And what do you know? We have actually, let me get rid of that period, a slightly adjusted ROE of 105.21%. So this figure was not exactly the same. Whoops, excuse me. 105.21% using the DuPont formula was slightly different than the 105.26% ROE that we calculated in part A. All right, so this video is already very, very long, and so we're going to close this out right now.